Hey everyone, welcome back to Corporate Decoder, where we break down the wild world of corporate finance. And today we're diving into Cyngn Inc's latest financial performance. Get ready because this report has more twists and turns than a roller coaster. Cyngn is aiming to put self-driving tech into industrial vehicles, and their latest report for the period ending June 30, 2025 gives us a peek under the hood. First off, Cyngn is the company, and they filed this report as a quarterly update. They are a smaller emerging company, which means they have a bit more flexibility in financial reporting, but also face unique challenges. Let's jump into the balance sheet. As of June 30, 2025, Cyngn reported total assets of about $56 million. A pretty significant jump from around $30 million at the end of last year. A big chunk of this increase comes from cash, which rocketed up to over $31 million, and they also picked up about $8 million in short-term investments. That growing cash pile is usually a good sign, especially for a company still developing its core technology. On the flip side, their total liabilities have shrunk considerably, dropping from about $18.5 million at the end of last year to just over $9 million by mid-2012. This is largely due to the warrant liability disappearing. It seems like those warrants, which are essentially options to buy stock, have either been exercised or expired, which is a positive development for the company's financial structure. And with lower liabilities and more cash, shareholders' equity has soared. It's up to over $46 million from about $11.6 million at the end of 2024. This huge leap in equity is mostly thanks to massive amounts of new stock being issued in offerings which we'll get to later. Now, let's talk about revenue. For the 3-month period ending June 30, 2025, Cyngn reported revenue of just over $33,000. For the first 6 months of the year, it's about $80,000. Now, that might sound incredibly low, and it is. This tells us that while they are starting to make some sales, the company is still very much in the early stages of commercializing its autonomous driving technology for industrial use. Interestingly, their cost of revenue, the direct costs associated with generating that revenue, was about $16,000 for the quarter and $28,000 for the half year. This means they are spending almost as much to deliver their products as they are earning from them, which isn't ideal but expected for a company at this stage. Where the money is really going is research and development. For the 3 months ending June 30, 2025, they spent about $2 million on R&D. Down from about $3.2 million in the same period last year. For the first 6 months, R&D spending was around $4.1 million, down from $6.4 million in the first half of 2024. While a decrease in R&D might seem concerning, the company explains this is partly due to capitalizing costs related to software and customer contracts. It suggests they are becoming more efficient in their development process, or perhaps shifting some development costs to assets on their balance sheet. General and administrative expenses, which cover things like salaries, rent, and other overhead, actually went up. For the quarter, it rose by about 36% to $3.6 million. Over 6 months, it increased by about 26% to $6.7 million. This rise is mainly attributed to increased personnel costs, indicating they might be bringing on more staff to support their growth or development efforts. And with all this spending, the company is still reporting significant net losses. For the 3 months ending June 30, 2025, the net loss was about $5.4 million, a slight improvement from a $5.8 million loss in the same quarter last year. For the first 6 months, the net loss was around $13 million compared to about $11.8 million in the first half of 2024. So while revenue is starting to trickle in, it's not nearly enough to cover their operating expenses yet. Now, what's really striking is the change in the number of shares outstanding. In the first 6 months of 2024, they averaged just over 1,700 shares outstanding. Fast forward to the same period in 2025, and that number jumps to over 1.5 million shares. This massive increase is a direct result of numerous stock offerings, which we'll see reflected in the financing section of the cash flow statement. This dilution means existing shareholders own a smaller piece of the company than before. For example, their net loss per share, which was a huge negative 61, the net loss per share, which was a huge negative 61, to own a smaller piece of the company than before. For example, their net loss per share, which was a huge negative 61 $10 in the second quarter of 2025. But that's because the loss is now spread across many more shares. Looking at the cash flow statement, the financing activities section tells a huge part of the story. In the 6 months ending June 30, 2025, they brought in nearly $30 million from financing. This is more than double the $9.6 million they raised in the same period of 2024. This influx of cash is primarily from selling more stock, with two major offerings highlighted in June 2025 gives them runway, but it's crucial they use this capital to scale effectively and move towards profitability. Let's look at the common stock section. It clearly shows the capital raises. On June 27, 2025, they sold over 3 funded warrants for about $14.7 million. Just a day before, on June 26, 2025, they sold about 92,000 shares and pre-funded warrants for over $12.7 million. These offerings, along with others late last year, show a clear strategy to raise capital by diluting existing shareholders, aiming to fund their product development and operations. Now, for a bit of drama under legal proceedings, Cyngn mentions a potential dispute with a former placement agent concerning a $2.3 million fee and warrants. They are contesting these obligations and haven't set aside any money for it yet. This is a risk factor to watch. The company is categorized as a smaller reporting company and also an emerging growth company. This means they get some reporting breaks, but it also signals they are still relatively small and perhaps less established compared to larger, more mature companies. In summary, Cyngn Inc. is in an intense development phase. They are successfully raising significant capital through stock issuances, which is boosting their cash reserves and equity significantly. However, their revenue generation is still minimal, and they continue to post substantial losses. The strategy seems to be that of a classic high-growth tech startup: burn cash to develop technology and hope to capture a large market share later. The sharp increase in shares outstanding highlights the dilution shareholders face. The company is actively managing its cash burn, and the recent significant capital infusion suggest management believes they have enough runway to execute their plan. The primary goal is to get these autonomous industrial vehicles into the market and generating consistent revenue. The key question is whether Cyngn can translate this capital into a viable product that gains traction in the industrial sector before their war chest runs dry. The competition is intense, with established players and other startups vying for position in the autonomous vehicle space. While the cash position improved dramatically, the minimal revenue and continued operational losses mean the path to profitability is still long and uncertain. Their compliance with Nasdaq listing rules after a recent reverse stock split indicates they are working hard to meet regulatory expectations, but the focus must remain on product execution and revenue growth. What's your take on Cyngn's strategy? Are they on the right track to revolutionize industrial autonomy, or is this a classic case of a startup burning through cash too quickly? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate filings. Also, join our Discord community for more real-time discussions. Link is in the description. Thanks for watching, and we'll see you in the next one.